Good morning and welcome to the new episode of Dr. Lamba's Awakening Call. Real estate is one of the most important matters that is of importance to every individual, every family, every citizen. And we have seen in Canada that as far as the real estate is concerned, there has been about 3 decades bull run. The price has been going, and in the last couple of years, they have been going to the roof. But it appears that this decades-long bull run is over. That the real estate is about to get ugly and uglier. A string of interest rates from the Bank of Canada have helped push the prices lower in a number of housing markets. But it has also made ownership the least affordable since early 90s. Buyers in the country's priciest market face the steepest mortgage bill increase. For instance, a 1% point increase in the rates increases the mortgage payment by more than $600 per month in Vancouver, $554 per month in Toronto, and $481 per month in Victoria. And this hike will end possibly in 250 basis points increase by the fall. So a couple of months more and you would find 250 basis points. The tragedy is that according to CMHC, more than 22 million housing units are needed by 2030. And when we think of the population, total population 35 million, and you need 22 million housing units, you can well imagine the issue assuming gigantic proportions and almost irreparable affordability crisis. What's going to happen? Look at the Toronto Stock Exchange Cap Real Estate Index. It has entered the correction phase. At first it was gentle, and the index took almost 4 months to fall under 10%. Then since May, pace has started galloping, and in the last 1.5 months, it has fallen around 18%. Now, when 18% fall in indexes there in 1.5 months, you can be sure that disaster is round the corner. But are the policymakers taking any action? This acceleration is definitely a bad sign for the sector. And the country is experiencing a substantial housing market slowdown thanks to the higher interest rate, and the prices have fallen over 20% in certain markets. Unfortunately, even with the price shooting down, affordability is not there. And I can tell you that it's likely to expect much is a hope belied. The conditions are going to get worse. Look at the residential REITs or the commercial REITs. Both are likely to be a bad bet. I used to think that investment in real estate income would be a sure bet. No longer. It is absolutely foolish to think that real estate investment in Canada, especially if planning on investing in the assets, directly might be considered a risky business in the current environment. The prudent thing is to wait. But wait for what? The shortage of 22 million houses and the reluctance of the builders, these two combine, and the lack of taking the issue on the wire footing. We are not fighting a war, but it needs an expeditious action. And what the fear was, as I said, is going to increase thousandfold. Evidence says that the housing market is cooling, and it has been obvious for several months, and there was no response from the government. But now some economists say the signs are appearing that reckoning will be worse, and I agree with that. An increasingly hawkish Bank of Canada, it is long since Mark Carney was the governor, and very pragmatic attitude was there. But Mark is no longer there. And Bank of Canada is widening the mortgage spreads. And the news that a lender has suspended new loan applications has prompted capital economics to deepen. The home prices to what I said earlier, 20%. If the home prices fall down to 20%, what happens? But look at it. The mortgage spread dropped during the pandemic when lenders were eager to offer home buyers financing. Pandemic receded and the trend reversed. And it reversed at a much faster speed than it has started. For example, capital economics, one of the biggest lenders, says that the spread between the discretionary 5-year fixed mortgage rates and an average for the insured borrowers and 5-year swap doubled from October 2021. And it was low to 60 basis points, now it's 120, almost double. The spread variable rates and the policy rates jumped by 50 BP to 170. 50 to 3 times more, 3.5 times. And what happened this month, in June? One of the largest private lenders, Magenta Capital Corporation, has decided to temporarily halt new loan applications until September. So June, July, August, September, and as at fall, we are going to see a major disaster looming. One lender stopped till fall, wants to see what fall brings in. And as soon as the situation worsens, or the indicators are there, we show that it may not be profitable, rather it will be sinking money, or they will stop spending as well. And according to Magenta, they account for a small portion of total lending, but it's a major player in some prime market. And its decision is only the beginning for others. You see, once there's a run on capital, then a rat race starts taking place. And so you can be sure there'll be many more of these mortgage investment corporations suspending lending in the next 8 weeks. And when you start modeling suddenly shows values dropping 5% every month in some markets, what else do you expect the investor to do? Naturally, they don't want to put money at a risk. So what happens when the investment dries up? Financing is not available. You would find that when financing dries up, the risk of forced home sales increases. Sometimes Canadian housing market has historically avoided till now. But now I think, and I hope I'm mistaken, that the forced home sales will become a routine matter. There is always hope that the situation may not be as dire, that the news might turn to be better. But look at it, only 3% of the homeowners in Canada with a variable rate mortgage face variable payments now would face pressure to sell as rates rise further. Some will have to renew at a higher rate this year. But considering rates 5 years ago, they were at the peak, they should be manageable. But the May's data shows evidence of forced selling already. Look at the May's data. The new listing rose by 4.5% from the month before. Don't be happy. They were lower than in February. So in March, people were thinking that there might be some increase. So they increased. But then the fall was much more than in February. And what about the surge in mortgage rates? That caused a huge hit to buying power. Home sales were down by 22% in May. And the year before, and shortfall of 22% in 1 year is shocking. At that time, the 5-year mortgage rate was 100 BP less than the current 5.1%. So while we do find fixed mortgage rates to drop back as markets come round to our view that the policy will peak at 3.0% rather than 3.75% as market pricing now implies. Much of the damage has already been done. So even if corrective steps are taken, the issue is not going to be solved right away. As a matter of fact, you can always think and review, and I forecast the housing prices to fall by 20%. Now look at the trend in the market. The Google's search for recession is spiking to the level last seen at the start of pandemic, and they are higher than the level seen in 2009. While this isn't exactly a mainstream economic indicator, it doesn't look good given the past precedent. It's indicative of the psychological attitude of the people, and that always is infectious. Somebody is scared and the fear would be transmitted to the others. The fear of recession has been growing steadily, and it's going to take some help and good luck to avoid a meaningful growth of overturn. So looking at it, now there are two aspects. One is the house buyers. The situation is very bleak for them. The movement towards or away from the urban cities to distant places is already evident. There's a welcome sign in one way, but not in the other ways. Then the investors, the people who invested in the real estate, and many people I know have put all their savings in that. What happens to that? So the market is scared. The investors are afraid and fearful, and justifiably so. In such a situation, what the government should do? Should it continue with this hawkish policy of increasing rates? When I say government, I mean the Bank of Canada. But let me tell you very frankly, Bank of Canada doesn't take unilateral action. It's a political compulsions camouflaged by economic conditions. And that's why when the recession hits, what do? You increase the availability of capital, not restrict it. Let me remind you of what Roosevelt did after the Second World War, when the situation was the same. He wanted people to have money, so he came up with a new deal. He didn't start giving social benefits, no. He said, okay, in the daytime, people will go out because they have no other work to do, collect leaves, put them in sacks, and those sacks will be placed on the roadside. They'll be paid for that. In the night time, other people would go, of course, on the roads, open the sacks, spread the leaves. Next morning, the day shift will come again, start collecting the leaves. So just collecting and dispersing the leaves created employment, generated money, built up hopes. It's incumbent on the government to build up hope and provide viability. At the same time, the interest rates have to be curtailed. It might sound contradiction in terms, but that's a must. 22 million shortage of houses is not something to be sneezed at. And if we don't take corrective remedial measures, the situation may not be happy and the disaster may come sooner than expected. Thank you.